Welcome back, everyone. Welcome back to Venture Wisdom. This is the place we talk all things venture capital and private equity. We have been covering a range of topics for last almost 2 years. One thing which we keep hearing and we have not addressed so far is how do the founders of the fund get compensated, right? And why I'm saying founders and not a partner or a fund manager, because fundamentally anybody who's starting it is an entrepreneur or a founder, and the GP or the manager happens later. I think it's a very important topic. The struggles are real, like any other founder. But then we would like to hear it from a gentleman who lives, coaches all these things day in, day out to the emerging asset managers. Joining me today, we have Simon Davies. Simon has been on our podcast earlier. If you haven't heard already, please go back, look at the episode where we did a primer for the emerging managers. And Simon is based all over the world, fundamentally UAE, but right now, as we speak, he's in UK. And last time we spoke, he was somewhere else. But then he's the founder of one of a kind accelerator for emerging asset managers. And today, as I said, we will be talking about the founders' compensation. Simon, thank you so much for joining us again today.
Rakesh, thank you for having me. Really looking forward to this one. I think some sparks might fly given we're talking about pay and compensation. And folks, if you didn't listen to the first one yet, Rakesh did an amazing job of just hosting us through quite a detailed convo. And I'm sure somewhere in the details below the video, we'll see the links to that first one, which was awesome. So great to be here.
So, Simon, you already heard and you know what we are going to talk about today, right? Founders' compensation. But then, as a layman for the outside world, and I always say it sounds, looks, appears so sexy and glamorous that you will be a fund manager, you will be a partner, you will be running a fund. That means you are a rich guy, right? And I believe the story is very, very contrary to what general people believe, and that's what we would like to unfold and break the myth that people generally have around the emerging managers and the founders who are floating the first time fund. So what has been your experience? You work with so many of these emerging managers, many of them first time. What mindset do they come in with, and what is the first shock or a surprise, pleasant or not so pleasant, that you see that people go through?
So great question, Rakesh. The first shock that we see almost every time, and it's probably a good place to start, therefore, it's the transition from an employed world, and let's be really honest with each other here, a very overpaid employed world for investment management professionals, then coming into a realm where they founded their own shops, and there is often an expectation that they will be matching what they just were being paid by the big brand they've just left, either immediately or within a very short period of time. The stats tell us it's going to take at least 6 years to actually get back to, and this is for a successful fund management firm that have got across that awful first 1, 2, 3 years, it's going to be at least 6 years until you're back to that sort of compensation. We can obviously come on to the mindset that we help and you help breed into people to get across that hump. But the core shock is that transition from what I was paid to what I am now going to have to face up to as a founder.
So, and many of them probably would have been founders who either exited the startup that they were doing, or probably just wrapped it down, right? And I'm again talking more from the venture capital point of view. I know the asset management per se is larger, and the people that you deal with are much more diverse than just the venture capital guys. But then, do you see a difference in that first time founder of the funds, in terms of the type of fund that they are floating as well, a VC versus a PE versus some other asset management?
Yeah, again, brilliant entree into a parallel issue, I guess. So, listen. If I read you right, I do agree that private markets founders, VCPE founders, particularly if they've come from some other startup, will almost always arrive with a more realistic view of their own founder compensation aspirations. Not always, but often. However, then they face, whilst we're dealing with the sort of glass half empty part of this podcast, then they face the next issue, which is a really tricky one to resolve, actually, which is, of course, that private markets funds in the main are considerably smaller in size than public markets. They're normally capacity constrained. They normally can't deploy anything close to as quickly, of course, as you would in a public market setting. Now, given that, the fee revenues that are going to be coming off a smaller pool that takes longer to deploy and build are going to be considerably smaller than they might in the public markets venue. And that clearly has an immediate bearing on compensation for the founders, the GPs, call them what you will, that sit at the top of the business. And that is often also a rude awakening for a lot of founders, because even if that fund is priced at traditional 2% plus 20% of profits levels, if it's a $30 million fund, it's going to take a very long time to get to a level with capital growth added in where the fee revenues actually allow a team to be paid. And I think this is the next awakening.
Yeah.
So I mean, that's my feeling. So the first two shocks in summary: can I get paid what I was being paid before? Probably not. And number two, oh, crikey, my fund size isn't really big enough for the fee revenues to pay the team I've got.
Yeah, yeah. So, but there are a couple of parts to it, right? And I think even those who are becoming the first time founders of the funds, they know that it takes time to raise money, and initially it's just their own money that they are running their shop with. So I think for that first part, they know that they will not be paying themselves because it's their money and they have to do a lot of things to get there. But if you have to break down that for 4, 5, 6 years time, what takes that long? How the milestones could be considered, and when is the first then that a founder can expect to be paid, and then perhaps we take it from there.
Yeah. So look, a podcast is not a podcast without some controversy. So I'm going to actually disagree wholeheartedly with the first thing you said there, Rakesh.
Uh-huh.
Look, if you and I were walking down Sandhill Road on the West Coast in Silicon Valley, meeting in the coffee shops tech founders who are on maybe their third, fourth, fifth startup, everything you just said is completely true. These guys get that they're putting their own cash into a business. There's no prospect of them taking any money out for quite a period of time, measured in years, not months.
Mm-hmm.
And the understanding of that, I would say, is almost complete. In the fund management space, completely different. I think your average founder, and you rightly say, I mean, I see probably certainly over 1,000 a year of guys pre-launch or on their fund one mission. I would say almost all have not figured out that there will be no compensation. To be clear, what I mean by that, month to month draw from the firm that looks like a salary. Very few of them have cottoned on to the fact that that will not be possible for a period measured in years. So that's the number one thing where
So
I
the
want to be.
disagreement that I hear is, so there's an agreement that either of them, whether a startup founder or a fund founder, they will not be paid. And I believe the disagreement is that the startup founders realize that they will not be paid, but the fund founders do not realize that they will not be paid for a long time.
100% right. And I
Okay.
think that the big emotional journey in the early month, 2, 3 months, is going to be getting head round that controversy. You ask rightly, why is that? Well, if you think about the things that need to be built, and by the way, no different in a fund management firm than a normal company. You've got to build in, whether that's software solutions, digital media, social media, sales, equivalent of engineering, R&D. You've got to build in these functions to be credible. It's going to cost money, and that's all got to be done before you can take a cent out the door. So in terms of what needs to be done to be institutionally acceptable, to be ready, to be credible in the eyes of your new investors you need to bring in to your fund, a lot has to be built. Now, by all means, do it lean. I'm a huge believer, to use an analogy from motorsport, the garagiste as opposed to the Formula One. Huge believer in, build this in a way that others are amazed what you did with so little, but it's still not going to allow you to take out any money for quite a while. And so I think that build phase is poorly understood. Bearing in mind, most private markets funds take a while to raise. Whether they make their way to 𝗥𝗏 Group and jump on one of our programs or not, the fact is it's going to take a little while to get to your first close. So again, you're not even generating fee revenue probably until year 2 of your mission. And as we said 10 minutes ago, even then that fee revenue is going to be relatively modest, right? And you've got to pay all these costs that you've just built in. Yeah. So I think that's some of the mindset challenge and shift that's got to be done. And you guys like you and I need to lean in and really help them with that.
Sure. So even if it is, say, 2 years for the first close or 3 years, whatever time it is, X number of years, how do we break down the phases of the journey and the life where you are paying for yourself, you are paying for your home, your mortgages, your children, if you have any, your wife, your family, medical expenses, and all that stuff. And by the time you are able to pay that first check to yourself, what are the phases to get to that point, and what is that first expectation? Because again, even if you are able to pay that first check to yourself, as I hear from you, is not what you were drawing earlier when you were employed, right? So what are those phases, and what is the first realistic check or a compensation that we expect? And then we'll come to the compensation structuring and all that stuff in a while.
Yeah, again, awesome lead down. So look, there's 3 phases in our minds that we look at all the time. First phase is, why are you doing this? You should be doing it, and I want to be quite pejorative there. You should be doing this private market setup, fund management setup, because you obviously have an absolute passion for the asset class you're in. You see an edge that others haven't got. And all that should lead to you focusing upon your carry and the enterprise value of your business on the long term.
Yeah.
The actual remuneration part should be way down your list of motivations, because it's going to be so hard to replicate probably where you were before.
Yeah.
Number 1. Number 2 is getting to the point you've actually got revenues. So at the start, you're pre-rev, pre-profit, and you're doing that mindset shift all at the same time. The moment you start to get to revenue, that should be enabling you to be properly paying for the other resources, not you, that sit in your business: software, licenses, team, etc. T&E. Once you go beyond revenue to profit should be the point at which you start to think, can this business start to pay me $5,000 a month, whatever the figure is. So by then, you've demonstrated to your investors, your team, your partners, service providers, you can run a responsible business. And so again, first of all, it's awareness of the why. To summarize, it's that focus basically upon your carry and your enterprise value. Number 2, it's hitting revenue. And number 3, it's hitting profit. And by profit, I mean net income. I do not mean EBIT. So if you've brought funds into the business to help you from friends and family or professional investors like us, most of those monies have probably got a cost attached, be it interest or a coupon. EBIT is not a good measure of profit, therefore. Net income is. So when a founder says to me, I've hit profit, my first question is, do you mean net income? And if I see net income and then a draw is started, a compensation draw is started, yeah, I'm getting comfortable with that. But
when you say net income, it happens when you make the first exit. that's where it starts, profitable exit, or is there another way to measure that?
Yeah, so net income for me, I just mean it at a very basic level. Fee revenue in at the top for that business, minus all its costs, including interest and depreciation and amortization of interest. So literally, fee revenue top, all the costs deducted. Is there anything left? If there's something left, net income, then perhaps the founder and the founder team should start to draw some money because they can afford to do so.
So you're saying that my employee team gets paid much before I get paid as a founder.
Absolutely right. Because if you don't do that, then we're back to an issue I know you and I are going to cover on a later podcast. How are you going to be passing operational due diligence with your serious new investors if you can't demonstrate you've actually put the plumbing in to your shop to be able to run durably? You know, if you've simply gone to Fiverr and hired a few people to do a few things purely on a contract by contract basis, and that's your entire team, maybe that's okay for a few months, but beyond that, it isn't, because you will not pass investor due diligence and therefore you're not going to raise any money. So again, founders going to have to be pretty close to the bottom of the list of compensation. Founder will be at the top of the list when it comes to carry and enterprise value, but of course they arrive later.
So before they get to that point, there are a lot of expenses that are taken care of, and fund does not have the money yet, right? Until they get to that point. Even if you have put that 1% as a GP, it still sits there, right? You have not called it yet. The money goes into a lot of other things that needs to be done. Where does that money come from?
So what we're always looking for, this is the best way I can answer the question. So I'm looking for the founder of a new VC fund. Let's be very specific. To demonstrate to me, and I mean show me, I don't mean tell me, that they have 18 months minimum of household expenses put aside in personal bank accounts in their family setup, so that I can see exactly that mortgage, schools, all the things you mentioned, Rakesh, are covered for at least 18 months and preferably longer. Secondly, I'm looking to see if there was any money left that the person could then put into his or her own balance sheet. So the new entity they've set up for their fund management company, have they been able to put some money in that as well? Thirdly, are all friends and family fully committed to that balance sheet? Is there visible commitment from F&F, friends and family, to putting a bit more money in there to start to pay for setup costs and such like? If I'm seeing zero household budget put by, no money, even if it's $20,000, put into the entity's bank account, and no friends and family, and yet coming to an external financier for support, I'm already pretty worried at the level of commitment of this individual. Fully understand that if you're coming from an emerging market and have had previously lower incomes from employed world than you might if you were working in the States, for example, completely understand that. It's all proportionate, but still the principle is the same, because your cost base, if you are a Bangladeshi founder, your cost base is also going to be way lower than on the west coast of the US. So it's all proportionate, but that's what I'm looking for. If you come to me and say to me with a smile on your face, I'm going to be setting this business up off my credit card, I'm going to be walking away pretty quickly, because those days have gone for setting up a business in this sort of realm, because others will also see that you're doing that and will know this is not a durable startup.
Sure. So keep money aside for your households. Have some money to invest in the initial part of the business. Get to the point where you can get paid as a founder/partner. How do we structure the compensation assuming that everything is going the way the plan is, phase 1, phase 2, phase 3, phase 4? How do we structure, and how does the compensation evolves over the life of the fund itself?
Absolutely. So, I mean, clearly the perfect scenario would be that the founder can eyeballs fully focused on the prize of carry and eventual enterprise value, i.e. a potential piece of M&A for his or her fund management business. The reality, of course, is rarely that. There's going to need to be this interim phase that we've been discussing where you want to start bringing $10,000 a month into the household to help with costs and bills you incur in your normal day-to-day life. Look, the reality is that normally we see a bell curve. We see a flat piece where the founder isn't able to draw from their business yet. We see a steeply rising curve at the point that net income arrives, profits arise, and they start to just take a bit of money out. Of course, at that stage, highly unlikely there's any carry being earned yet because the deals are not old enough that they invested in to be creating profits. Then we see back down the slope of the bell curve once carry does start to arrive. And of course, the founder can then rely upon being paid from carry and can probably cut month-to-month compensation out completely. A, because it's not tax efficient normally, depends where you live, to take that. But also B, the carry should vastly outweigh the scale of the amount of compensation you could bring out the business.
That's the objective, yeah.
Exactly. So we see a bell curve, flat, steep, steep, flat. And that's a normal dispersion of a successful business. Clearly, if you come in, and this is super rare, so I don't want to labor this point, if you come into your private markets new fund with significant personal balance sheet, you're not going to be worried about your compensation probably ever. But I would say 1 in 100 founders I meet are in that position. The other 99 are not in that position and are very conscious of having to live without an income for quite a while.
Mm-hmm. And how does the LP/investor mindset influence the founder compensation outside of the carries and management fee and the terms which are there on the LPA, right? But the month-on-month compensation, assuming that we get to that point.
Yeah. So look, I think it starts with something which a lot of founders find emotionally difficult, and that is that the modern LP, the modern investor in your new fund, is going to ask these questions. So let's start there. There was a time 10, 20 years ago where the idea of someone asking what you got paid from your own business was probably not going to get raised apart from maybe socially. Now that's changed. So be ready to be transparent from the get-go. Therefore, it does affect, the LP attitude does affect what you do, because if it's clear you're taking money out from the very start, when the business can't really afford that and you're only really spending investor cash before you've invested in your business, that's going to be a pretty poor look, and LPs are going to see through that pretty quick. So be aware that that question will arise from the start. That's the most important thing. Then I think it's probably common sense. If you are going to need compensation, do a step-based approach. Tell your LPs, at the moment we hit revenue, I'm going to take a modest sum per month, very modest, $2,000 or $3,000. When we hit net income or a second close or a third close, I'm going to increase it again. Make it relevant to the milestones of the business. Make you, again, to repeat what we said a minute ago, make sure you still appear at the bottom of the food chain or close to the bottom relative to your team and other costs being paid.
Understood.
So LPs will often say, and this is a catch question, which a lot of GPs fail. I see you've got Rakesh, John, Jane, and Barsha on the team. What day did they get paid last month? A lot of GPs struggled because they got the invoice, they didn't pay the guy for 2 weeks because cash flow was a bit tight. They should have paid same day, because then you can turn to your LP and say, yeah, submitted an invoice on the 31st, got paid on the 1st. These are many of the tests which the modern LP is using to assess how you run your shop, and they will ask.
Interesting. And when you say the transparency from the beginning, right? How you will be compensating yourself and your team, the fellow founders, and so on. Where does that transparency start, and how do we present it? Does it go on the DDQ? Does it go on the PPM? Does it go on my fund deck? Where does it go?
So you're going to have a 3-year budget and actual P&L in your data room. That's going to be where it shows, because that's going to be month to month for 3 years. Now, you and I know, everybody listening knows, those numbers will end up being wrong, because of course they are, but they will give a clear sense, particularly on the cost part of the P&L. So the bottom half of the page will give a very clear view as to what you are going to budget to spend on each of the people and all of the services you need. Now, if it's clear that you as founders are at zero comp for X period of time, you are already having a story to tell. The LP can ask questions. Hey, it looks like you guys are not paying yourselves for a year. Is that right? Did I read that right? You're already getting into a sensible conversation. That's where I would put it. I'm not saying it should be with a flag waving. Hey, aren't we clever? We're not paying ourselves. I'm saying that it should be in your financials.
Of course. And if you have to structure the founder compensation, where all do they get compensated from? Is it from the management entity? Is it from the fund? Or is it elsewhere? And how do we really structure that?
Yeah, this is actually a great question, and a lot of people get this wrong. So I always think about it. You will have an operating company above everything you do as a fund management business.
Yeah,
Whether you have one fund or 1,000 funds, you will have a management company. Now, that company will feed money into the operating company that you own, or you and your partners own. You're taking your comp from that in the early days, because that's the vehicle that will receive revenue from the fund fees that you are generating. But
correct.
it will also be the vehicle that pays all the bills, staff, services, all the other things we've discussed. And so that's the entity you can see clearly whether it has any money or not. I would strongly avoid tying comp to a specific fund product in the early days. Later on, when you've got a successful 9-figure, 10-figure AUM business, that's different. But we're here talking about the emerging days, early stage days. So I would focus on the OpCo. Think about it. If you are running a bakery in Bangalore, it's no different. What's coming in? What's going out? Is there anything left?
Yeah.
It's absolutely zero difference to any other business. And that's the mistake a lot of fund founders make.
Sure. So practically what I hear is that most of the compensation, particularly from the month-on-month point of view, whenever it starts, comes from that operating/management entity. And then once you start making exits, there are profits from the exits. Then the fund pays you as a GP, not as a founder, but as a GP, because GP has its own profits linked to it, whether it's 80 or whether it's 20 or whatever it is. That's upon the terms. So that's what we're hearing right now.
100% right. And that comes all the way back, doesn't it, to the mindset that if you are doing this for the right reasons, you're motivated to get to the point where the 20%, let's say that's what the deal you've hit with your fund is, that's of the profits you make on the investments you make. If that 20% is really where the juice is going to be for how you get paid, and then in 11 years' time, you sell your business for a 10 times net income multiple, those are where your focuses really need to be, because
Sure.
that's where the big money is. And that will mean you've done an amazing job for your LPs, because for you to get your 20%, that means they've had their 80% of those deals, and therefore they're thrilled. And so to me, that's where you've got to be. Now, we all know we've all got costs to pay. We've all got kids and whatever else. I get it. But this is a business like the proverbial bakery, where you've got to get to the point there's net income before there's going to be anything for the founder.
Yeah.
So I think that mindset's the toughest mindset. Again, let me be controversial. It is not unusual for a distinctly average portfolio manager, particularly in North America, to be earning $500,000 a year working in a fairly big private markets, public markets, asset management business.
Yeah.
Now, that individual is never going to replicate that comp in their own shop for years. It's a tough emotional journey that I get it. I really do get it. But we've got to be, you and I on podcasts like this have to be realistic.
Yeah. So two things here that come to my mind. First, which is I think which is more uh, behavioral slash emotional. That how do you see those managers coping with this shock when they get it for the first time, right? So that's what I would like to hear first. How do you as an accelerator coach help them get through that journey? And then I'll perhaps come to my next question, which I have.
Look, first thing I would say is that it is immensely hard and we don't get it right all the time. Because it's an emotional journey, and you absolutely rightly point that out, it's behavioral. I don't think anyone from my side of the fence can say that the journey with each of their founders was smooth when it comes to the compensation conversation. I think it's a tough convo. Here's what we constantly work on. How early can we make sure we raise this conversation? And as early as possible is the answer. And we do that both verbally and in writing a number of times. If you join our accelerator, in the contract itself is a very wide-ranging FAQ. So I think there's 50 plus items from memory in that FAQ. Really, we want people to soak that in. And a lot of that is the behavioral issues of starting a business, compensation, and many other things. So really, even at the point you're joining an accelerator, we're asking you to really think hard about this. Then before you even jump on the program with your peers, my team would be working through with you on a one-on-one basis. Where are you on that behavioral journey? Let's figure it out. Where's the gaps? What can we help you with from our experience? What's not going to look good in the market? So I think the answer is it's a multi-stage process before someone's feet are too wet with their startup or their early stage firm. But it doesn't go well all the time. I'll be fully transparent about that. The hardest convos are from, of course, guys who have not founded a business before, ever. And number two, come from a large global bulge bracket brand. Those two scenarios does not mean the person shouldn't become a founder at all, but it does mean the transition is super hard.
Yeah, I can
And
imagine.
we certainly don't succeed at that transitional conversation all the time. I wish we did. I think the reality is we get it right 7 out of 10, 3 times. The transition's just too hard.
And so in this case, how acceptable it is from the LP community, and how often do you see it being done by the founders picking up a side hustle or an advisory role or something, and do a side gig which does pay their bills? Is it acceptable, one, to the investors? Second, do we really see that happening much?
This is again a superb question area. And look, I think this is where there's some wiggle room. Whilst I need to see that the founder is, of course, deeply focused on his or her shop. Clearly I do, right? That's just common sense. I am willing to have a conversation around someone saying to me, look, I'm 90% over here. I do need to bring in $150,000 a year over there. I've got a couple of positions that enable me to do that. I need transparency on it, number one. Don't hit me with it in 4 months' time when I find out. Tell me now. Let's figure something out together. I need to understand why you need that hustle. Forgive the direct intrusion into your personal finances, but I need to understand it.
Yeah.
And we probably might be able to come to some accommodation together. And an obvious example might be someone living in, say, North America with huge healthcare costs. You know, trying to replicate health insurance that they had at a big employer is expensive. Maybe there's a bit of hustle needed just to cover the family's medical, just as an example. So I think let's talk about it from day one. Let's not hide it. We always require a monthly dashboard of data from anyone we invest in. So I'm going to see it anyway. If it's clear to us that we're not quite getting the full juice that we thought we were from that founder, I'm going to be asking anyway, hey, it looks like Fridays, you're never really here. What's going on? So I think that's the answer to the quiz question. I think if it's got to be done, let's do it transparently.
And how often do you see this happening?
A lot. I mean, I think probably half of the founders we deal with are having to think about how they do top up what they put in the personal bank account to keep them going. Now,
Sure.
the problem is the transparency. And again, I'm going to be controversial. 8 in 10 don't really want to say anything.
Hmm.
2 in 10 will tell you from the get-go, I'm on 2 boards, or I've got this role with this founder over here. It's topping up income. I really want to continue it. It stops me drawing from my new fund management business for a while. Are you good with it, guys? Brilliant conversation. Let's figure it out together collaboratively.
Sure.
Hide it. It's a problem, and it always comes out in the wash later.
Sure. So what I'm hearing is that while the journey to get to a point where the founders can be paid is long, it has an ample room of flexibility as long as it is structured right, connected to the milestones, and there's enough transparency maintained between the investors and the founders. Is that what I'm hearing?
Very well put. And I want to just add to that a rather obvious point that, of course, if you are starting your firm and you do not need external financing at operating company level, knock yourself out. Spend your own money on whatever you like. No, we don't care. We're only referencing here the founder who says, I want to build a franchise of great scale. I need some external money to help me build it out. And it's in this scenario this conversation is happening today, where someone like me and many others come in with a big check at the start to help you build out your firm. So it's those scenarios we're looking for this level of transparency and responsibility.
Understood. And I'm glad that you brought that point up, because towards the summing up side of our conversation, I wanted to bring that up. Again, like you always say, what's a conversation without some controversy? And let me spark one here. From the economics point of view, right? While we may see those 10, 15, 20, $30 million funds being raised by founders, from the economics point of view, what is that threshold where it makes most sense, where a founder perhaps can look at being paid? I don't have a definition of a decent compensation. I'm just using that word right now, though. But then, whatever subjectivity attached, to get to that decent compensation, what, from the economics point of view, a fund size makes sense?
Yeah, brilliant question. Look, if someone wants to be drawing a 6-figure sum, let's use US dollars as an easy proxy. If someone wants to be drawing a 6-figure sum from their private markets fund management business, month to month comp, just to be clear again, we're not talking carry or enterprise value. If you are not managing $50 million, you've got a team, you've got the cost of running a fund. They will be much bigger than most people ever believe from the start, by the way. And all the other costs of T&E and goodness knows what, then you've got to be running $50 million at a 2% fee rate, $1 million a year of revenue, to start to be in a position to perhaps pay yourself $5,000, $6,000, $7,000 a month. Beneath that, the only way you're going to be paying yourself is that your team is so lean that effectively, fantastic, you're running a net income business, but probably you're not going to be very credible to the outside world, because the moment someone does a scratch and sniff test and sees that it's you and a fractional analyst who really isn't your guy anyway, and that's it, it's going to be very difficult to invest in, i.e. people writing tickets to join your fund as an investor. It's going to be a very difficult place to join. Friends and family, no problem. But we're talking beyond the friends and family group.
So what I'm
So
hearing now is that you are being nice when you say perhaps $50 million is a right AUM to manage to get to that point. And what is not said, and I still hear, is perhaps that's also on the lower side of it, right?
Yeah, I mean, the reason I have a sort of little smile on my face when I say it is because you and I know really well that if you are operating in VC Fund One in a deep niche that you happen to be a subject matter expert in, the chances of your first fund being much more than 30 million are very small.
Mm,
Fund two might get you over 50. Fund three, four, five might get you into that nine-figure AUM territory. But I guess my point is you're still going to be running a bunch of money that actually is still not really economically viable.
yeah,
And so in a public market setting, you would be saying, look, until someone's probably running 100 to $250 million, it's very difficult to pay the bills. And it sounds crazy, right? Because that's a massive sum of money. But of course, in public markets, the fee rates are much lower generally, apart from perhaps in the hedge fund side. But
yeah,
in private markets, you might be really doing an amazing job of stewarding $27 million. Your fee revenue is $550,000 broadly, top. By the time you've paid your costs, if you're building out a business, not running a lifestyle, there's not much left.
yeah,
And so that's why we've got to be thinking about those AUM levels 50 and above. Admittedly, to repeat, we're not going to get there overnight. So there's another reason why the compensation draw is going to take a while to achieve.
agreed, agreed. No, I think that kind of sets the tone right because I think as I started this conversation with that to the world outside, including those who have been thinking of being a fund founder, expectation is much different than the ground reality. And a reality check like this before you actually get in and get a rude shock is important one. And I'm glad we are having this conversation today and are able to bring those points factually up that would help them take a wise decision or an informed decision whether they should take that route or not.
I think that's right. Look, I know we're coming to the end. I wanted to make a couple of very brief points. And again, one is it probably is a bit controversial. So forgive me in advance. Private markets founders, private markets fund management founders, if you are coming from a private markets existing large brand asset management firm, the vast majority of those folks will not make a business themselves that ever pays them more than they just earned.
Mm.
And I even include carry as well as compensation in that metric. Now, it almost sounds like anti-entrepreneurial to say that. It's definitely not that. It's a reality check situation.
Yeah,
Very few will make it to where they were before, and that emotionally is quite difficult for
and
any
that
of us.
probably will be when you get to fund three, fund four.
It will, and of course, most firms don't ever get to fund three, fund four, and so they, in truth, they get to fund one, fund two, and then have to close the doors or pivot, and then effectively they find themselves back in employed world in 6 years' time. Now,
Yeah,
nothing wrong with that. I am not claiming anything wrong with that at all. I'm simply saying that have that in mind before you make the leap.
yeah,
So that's one cautionary tale. On the other side of the coin, a bit more positive. If you can get the mindset locked into your carry and your enterprise value, which are fully aligned, therefore, with doing an amazing job with for your LPs. Of course, the overall numbers you are heading to are of a different magnitude than you ever earned at an employed shop.
yeah,
And so if your eyes are on that prize, then you really can do incredibly well personally. And let's face it, we've all got a massive personal financial motivation to set up these businesses. Let's not
yeah,
hide that. But let's make it aligned with your LPs. And
yeah,
I think that's often missing. I meet a lot of fund managers who haven't really thought through that alignment. But look, the back end of a business running, let's say making 1 million net income on decent revenues in a few years' time, you're going to be selling that business for 10 or $15 million. And unless you were an absolute rock star where you were employed before, it's unusual you would have been paid that sort of money where you were before. And if you are, think hard before you leap.
Yeah, I hear you. So, to all those who are watching and listening us today, while this conversation may sound anti-entrepreneurial, as Simon said, it actually is not. I think it's our effort in our own little might to keep you aware of what you expect. And believe me, I have seen the cases much more than heard that people are actually able to make good money from fund two onwards, depending how focused they are in their fund one and how well they make sure that fund performs. I have seen a huge delta, as much as a first fund of 20 million and the second fund of 150 to 100 million dollars happening in reality. Depends again on how focused you have been. So don't take it as an anti-entrepreneurial conversation, but be aware of the ground realities before you get into it, as Simon mentioned. So Simon, great insights. Appreciate your time. Great thoughts. I am pretty sure people will think hard once, twice, thrice before calling it only a glamorous money business before they get into it. So appreciate your time again. Thank you so much.
Rakesh, thank you for having me. Looking forward to part three. And as ever, amazing job, brilliant questions. And I hope, folks, you got something from it.